right. Thank you for your patience, everyone. Thanks for being with us today, and welcome to another edition of the Gray Report, a special edition, a live edition. We're going to be covering our latest research report from the Gray Capital research team, the multifamily window, why 2025 could be the best year to invest in a multifamily, best year that we potentially could have seen in a long time. We're going to get into some introductions, but I wanted to first just talk about kind of why that we decided to create this report. Because if you're looking around in the economy today, if you're watching CNBC, or if you're halfway paying attention, the world is crazy. The markets are in turmoil with equity prices all over the board and just palpable uncertainty. That was really the inspiration for us to put this report together, to understand some of the near-term challenges, the near-term extreme risks, but then also grounding ourselves a little bit with the longer term fundamentals of housing and the multifamily space. Because with uncertainty and confusion and psychology, it leads to indecisions, and that itself could lead us into a recession if we are not in one already, which could potentially create an incredible opportunity. So first, let's get into some introductions. I'm joined by Dr. Matt Bastnagel. He's the Director of Communications and Marketing here at Gray Capital. He's also the producer of the Gray Report, author of this latest research report. Matt, you want to introduce yourself real quick, or anything else to say?
No, it's been really exciting. A lot has changed, and I'm excited to kind of dig into what we've got here. And I have the pleasure of introducing you, if you don't mind me. You are Spencer Gray, CEO and President of Gray Capital, and I'm just excited to share what we've been learning throughout the past few months and how things have changed.
Yeah, it's changed a lot, especially in the last couple of weeks, and we'll get into it. But just, Matt, we were talking about on the last episode of the Gray Report, and just between you and I, it was probably about 4 weeks ago when we were hearing predictions of everything in the economy is absolutely perfect, no chance of recession, and you and I said, well, that's the perfect moment to say, let's look out for the recession calls in the next couple of weeks, and all of the changes to the global economy, whether it's trade, tariffs, taxes, government employment, a lot's changed. And also same thing with multifamily, inflation, and real estate. And so that's exactly what we want to talk about. But first, who we are here at Gray Capital. We are a multifamily commercial real estate private equity firm. We're vertically integrated. We're located in Indianapolis, Indiana, and we are acquiring stabilized properties in the Midwest, primarily in Indiana, Ohio, Kentucky, and Michigan. Again, based out of Indianapolis, and we're operating in all of the states next to us, with the exception of Illinois. We've done about $2 billion worth of transactions, nearly $1 billion of assets under management across our portfolio, typically looking at core plus and value add opportunities. As I said, we're vertically integrated, do our own property management, construction, design, management services, and what's a little unique is we have our own multifamily intelligence division, which produces the Gray Report, these research briefs, the podcast, and the newsletter. We're an incredibly data-driven operation. We love data. We love talking about markets, and we provide it as a service to our investors, partners, and friends. So let's get into it, Matt.
Yep.
I want to talk about the macro uncertainties, the economy, and we first have to acknowledge the futility and even trying to forecast. And predict the future. We don't know, but we can look at the signs. And the signs today, I'm not saying in a couple weeks, but the signs today are relatively troubling.
Yeah, and what was interesting about this report is it started at a time in which the markets had not been flashing the recession signals that they are now. And one of the inspirations of this report was some messages that we'd been receiving from investors about their own opinions about where the market is heading. And there was some trepidation. There was some worries that our investors were maybe ahead of the market, as they often are.
Yeah, well, if you talk to a lot of commercial real estate professionals and investors, they tell you that, we've been in a recession, and specifically just talking about commercial real estate. I mean, with sales volumes being incredibly low over the past several years, asset values have declined anywhere from 15 to 30% in some cases, depending on the markets. Rent growth in case of multifamily has been negative for most markets across the United States. It's still very negative in the South, the Sun Belt. It has been positive in the Midwest, in the Northeast. But the reality is that a lot of multifamily investors, they're experiencing distress in capital calls. It's widespread. We talk to investors every day, and it's a shocking percentage of them, those who invested in deals over the last couple of years, that are currently facing capital calls. And what that tells me is that, those capital calls are in progress. And some of those capital calls will be successful, and the proverbial can may be able to be kicked down the road for some of those owners, some of those projects. The long-term success may be questionable. Not all of those projects will have successfully fulfilled capital calls. And some of those assets are going to have to find homes, whether it's going to receivership or just going to the market and taking a loss to those investors. And so, again, talking to multifamily investors who are going through this pain right now, we thought it was important to isolate the now and the reality of doing deals the last couple of years in 2022, 2023, because doing deals in 2025, the 2025 vintage deals and 2026 vintage deals most likely have a dramatically different outcome than the deals being done in 2022. And so it's challenging to compare the two, even though they're still apartments, they're multifamily deals, and so they look the same, but the fundamentals are quite different. So getting into the macro story, uncertainty is not a question. We're just looking at just global uncertainty index. We're basically peaking back to levels that we haven't seen since the pandemic. And really, we have to go back to the European sovereign debt crisis to go back before the pandemic to reach a point in time where we were so uncertain about the global economy. Just economic policy uncertainty in the United States, it's spiking. It's not just a little bit of tick up. It's quite extreme. Again, we really have to go back to the pandemic in 2020, which we turned the entire economy off. We didn't know what we were going to turn back on, what it was going to look like. We were sending out stimulus checks. We have to go again back to the European sovereign debt crisis in August of 2011 to get back to a point in time. That's when Greece was was failing. I mean, the entire Europe was in question, and that was just in Europe. We're talking about the United States and the entire global order in terms of trade, fiscal policy, and monetary policy.
It's interesting. For global economic uncertainty, in 3 short months, it went from a reading of 234 to 460. And that's only 3 months. And in the same period, from October to February of this year, roughly the same period, U.S. economic policy uncertainty went from 109 to 334. So in terms of like the multiple, U.S. economic uncertainty has really grown considerably.
And one of the reasons why we're focusing on uncertainty and sentiment so much is because so much recessions are often, and just markets in general, they're driven by psychology. They're driven by feeling. And when individuals and businesses are uncertain, it leads to less spending. It leads to less decisions being made. And that alone, even in an otherwise...
It's the risk premium.
Exactly. I don't know what's going to happen. You're rolling the dice.
Companies and investors will pay more for the certainty of something
100%.
than the uncertainty of something, whether it's like a loan, like a forward-looking loan curve or something like that, or maybe it's the cost of rebar that went up earlier this year in anticipation. They were saying, okay, I'm willing to spend a little bit more because I don't know what's going to happen. I need that guarantee that the materials are going to be there. And so that's kind of happening throughout. And also, I wanted to just connect really quickly back to some of the nervousness that the CRE markets were feeling in the beginning of the year, was 10-year treasuries were more elevated. They're still elevated, not quite as high as they were before, but that's just going to be an interesting kind of X factor as the economy develops.
Well, and we could talk a lot about the 10-year treasury, whether it's, the Trump administration seeming to have a desire to get the 10-year treasury lower, which has a multitude of effects, because, that would be music to commercial real estate owners and borrowers, the ability to potentially refinance or to see a positive effect and downward pressure on cap rates to either sell or refinance. Now, the question comes, again, why will the 10-year Treasury be lower? Why will interest rates be lower? Is it because we're just in a slower growth economy, we're achieving an immaculate soft landing, or is it because we're entering some sort of recessionary period or period of contraction of where we're just seeing such slow growth, so where we may have to make some discounts in terms of even some rent growth in the short term as well, and just the economy isn't in nearly as good of a shape. But the point that we're making is, again, some of the fundamentals, like unemployment is still low, wages are still rising. There's a lot of fundamentals, many of them lagging indicators, not leading, that would point to everything's fine. The economy's looking good, and we could get we get some new data or clarity on tariffs, clarity on economic policy, fiscal policy, monetary policy, where a lot of this negative sentiment goes away. But assuming that it doesn't, just that, again, the psychology and the sentiment can lead to reduced consumer spending, business spending, and that itself drives us.
No,
into
that's a good connection there. So sentiment is down. Inflation expectations are actually up, and that's probably from no one's surprise. The inflation uncertainty, as measured by the Fed, which measures the difference between higher and lower inflation expectations, I thought it was just these are uncertainty means it's going up, but no, the people just can't decide now, and that's been going up consistently, basically up from 3.4 to 4%, according to the New York Fed's numbers. And then those inflation expectations that you saw a moment ago, they jumped from 3.3 to 4.3 in February. That was the second biggest monthly increase and the biggest one since November of 2023. They, in the University of Michigan, are connecting it to the January 31st announcement of tariff hikes. That's definitely looming over the economy right now and other kind of government policies. But however you shake it, you're just looking at these numbers. People are expecting inflation to come up, and that is that runs counter to.
They're also very uncertain about it. And as we were talking about yesterday, I mean, tariffs, you can draw a line to make them absolutely inflationary unless it leads to less spending. And the prices can be high, but if you're not transacting at those high prices, just things aren't being done in that low growth, and so it's what is the net result.
You've got to have that low so the ideal is have very low inflation and then growth, and then maybe the Fed funds rate could go down and then the 10-year Treasury might go down in that situation. But otherwise, if inflation does stay high, then maybe we'll need a recession or something, or an economic downturn or lower growth period in order to bring that 10-year Treasury down.
Well, and certainly the Federal Reserve isn't going to have the ammunition to lower rates. Most likely, they'll have to keep rates where they are, and maybe even hike rates a little bit more. And that would be. So again, when we have these exact scenarios we're going to talk about in just a second, we'll get into. But in the case where rates stay where they are, go higher, that all of a sudden forces some borrowers that may hand those keys back to the bank. They're not going to be able to refinance. They're not going to sell it at a favorable price. That creates a potential forced selling environment where additional volume of assets comes on the market, and it could create an opportunity. Even though that what I was telling Jay this earlier, asset prices have to come down or interest rates have to come down. Both can happen, but really needs to be one or the other. But truly, if interest rates come down, asset prices are going to stay where they are, or they're going to go up. But if interest rates stay where they are, or if they increase, we're going to see a further decline in asset prices.
That's one of the things that I think I'm pretty confident about in terms of like investor sentiment. Consumer sentiment mixes in with investor sentiment, I think, a lot, right? But I think if interest rates come down like they are projected to come down, and they are, and right now we're seeing projections for the federal funds rate, and actually the revised projections based on this recent economic downturn should have these going down even further than they're indicated here. But this is a fairly accurate representation here of rates going down. That'll get investors excited. Even if there is kind of a downturn in the economy, I think that investors will pick up interests, whether they're institutional or individual. I think that individual investors will be quite interested in transacting if interest rates, like 10-year Treasury, goes down.
I absolutely agree. So just, again, kind of trying to kind of sum up this, not a direct call for a recession, but just pointing to the evidence. Last month, released this month, but for February, the Atlanta Fed has a GDP now, and they are essentially estimating that the GDP growth in February was negative, leading to an annualized rate of negative 2.4%.
Yeah.
This is that first data point that shows, could we have been in a recession? And what we're not including in this is just, again, the technical aspect. We're talking about the psychology, but just the technical aspect of moving public sector jobs to the private sector.
Yeah.
And that in between time, there easily could just be a technical recession from a rejiggering and a realignment of
that's a very good point.
National economy, but also kind of the global trade paradigm.
Yeah. Yeah, that GDP, I think that GDP announcement took a lot of people by surprise, and perhaps even the GDP, because they were like, perhaps even the Atlanta Fed themselves, because they were like, this is just what the computer's spitting out. And I think that it is valid, and it has been persuasive for a lot of people.
Yeah. So again, just some of these key economic indicators. We've got negative estimated GDP growth. We've got unemployment rate that is pretty low, but it is rising. Inflation is kind of moderately slow declining.
Yeah.
And Fed policy, well, it's kind of a wait and see. Then the risk and uncertainties, trade policy, tariffs, who knows? It's changing hour by hour, minute by minute. The political environment is also chaotic. And so what does this mean? We've laid out 3 monetary policy scenarios and have derived recession probabilities based upon those scenarios. And very quickly, because we touched on it, one is basically a base case of keeping rates current. The second would be gradual rate cuts, decline by 50 to 75 basis points. The third would be aggressive rate cuts, 100 to 150 basis points. But through our analysis, if the Federal Reserve keeps the rates the same and other underlying fundamentals remain as they are with negative sentiment, we're looking at a 70 to 85% probability of a recession in 2025. If we see some gradual rate cuts, we're looking at closer to 50-50, really 50 to 65%. If they do some gradual rate cuts, that's still a moderately high probability. Now, if they get into aggressive rate cuts, we can significantly reduce that probability of recession. There's so many more factors that go into this, but right now, that's the situation that we as investors face of a possibility of a recession. And we have to keep this in mind that others are going to be running to the sidelines. That clears out the field for us to make some opportunistic investments.
Yeah.
And again, when everyone else is just running for the hills.
Just to put it into context a little bit about probabilities here, currently the CME Group's FedWatch tool has interest rate expectations for the end of the year at 3.5 to 3.75. So right at that middle point, the higher end. So maybe they'll come down 0.75 according to these projections. And then the same thing for 10-year Treasury. They're currently projecting it to decline to 3.8%.
Yeah. And who knows? I don't think that they know. But so at the bottom line, moderate probability of a mild recession, where there's negative confidence and uncertainty that may lead to reduced growth and investment activity. But we all have to acknowledge the futility of forecasting, the futility of trying to predict the future, and it's going to change day by day, minute by minute. Yep. But just that in itself, that uncertainty will lead to less decisive action and potential opportunities depending on which timeline we find ourselves.
Well, and like depending. So we've matching this uncertainty, and if there's stuff that you do know that other people are uncertain about, then that's where you can find that opportunity. And again, that's like one of the reasons why we had this report is we were seeing this uncertainty even before the stock market took a dive. We were seeing that uncertainty, so we were like, okay, what are the real facts? What are the real things that are years in the making that overshadow and give us a sense of confidence and certainty that overweighs the current temporary volatility and uncertainty?
So at the end of the day, we're not traders. We're not trading in and out. In fact, we're long-term value investors. We're active value-add investors who look to find intrinsic value and look to create and force more value by improving the assets themselves. And so, we're doing this for, 5 to 10 year hold periods. And so we always have to take a longer view approach. Again, it's easy to stick our kind of head in the sand because it gets scary out there. But if we're in the business, as you and I are, of making sound investment decisions for the long term, we have to use opportunities of volatility and relative chaos to find that value, especially in today's market where we're not really seeing much value. Again, cap rates that are low, close to 5%, even sub 5%, in an interest rate environment where the 10-year Treasury is still, at 4.25. That spread is just too tight historically, which indicates that it should widen at some point. And there is the recipe out there for that to happen, which is why we're excited for the end of the year. Let's get into the fundamentals. Matt, so starts and deliveries. Supply has been the story for multifamily for the last several years. 50-year peak in new deliveries. Get us up to speed, kind of where we are with supply, but then starts. What are we actually building now in the future?
So supply is still elevated as this new wave of apartment deliveries recedes, but starts have declined, and new deliveries are projected to decline sharply as well, really by a considerable amount. So we're talking like half, basically cut things in half. Right now, starts are at 59,000, and at their peak, they were 147,000. So that's more than double, really. And the same thing for completions. During the peak, the completions were 192,000 in Q2 of last year. And then the projections, again, like we're basically separating by 2.5 years from start to completion. So starts went down. Now we're at a low point in starts, and then in Q3 of 2026, we will get 62,000 completions. That is well under the 192,000.
62,000.
Yeah. That's in a quarter.
Okay.
And that's well under the quarterly record of 196,000.
Either way. That's incredible. So, I mean, really what we're looking at, and it's hard to stay up to speed because when you're living in a world where we have a glut of new supply, to imagine a world of where we have a scarcity is a little bit challenging. But it's not too far ago. We have to remind ourselves where we have had and still have a housing crisis. We still haven't built enough housing units. We've just been delivering a huge concentration of new housing in many select markets. The bulk of these deliveries are all going into the Sun Belt. Not that there aren't major supply waves across most markets, but most markets, especially in the Midwest, Northeast, even the mountain states, are relatively balanced relative to the Sun Belt. But when we crest over the hill, we just don't see any deliveries coming. So we understand that we've been in a high supply environment, and we have a great deal of confidence that there will be less supply coming online over the next several years. And then coming back to tariffs and costs, I can't imagine a world in which steel, aluminum, lumber are being tariffed of 25% or more, that it gets cheaper to build. Labor's not getting any cheaper. Wages have been outpacing rent growth now for the past couple of years. Wage growth has been strong. So labor, materials are all more expensive. It's going to cost more money to build these communities. That means fewer will be built, especially if we still have any degree of uncertainty.
We were talking about a barrier, interest rates being a significant barrier, and that is what has been the barrier to multifamily starts in the past couple of years. Even if the interest rates come down this year, the new barrier could be increased labor, increased materials costs.
The costs are still going to go up.
Yeah.
All right, now we've talked about supply. On the demand side, this is, to us, I think, has been the more surprising story because we saw the supply coming. We saw the starts earlier. But, Matt, tell us about the demand story. I mean, it looks like this is a very positive. I mean, this is like a year-by-year chart, so it's pretty well zoomed out over the last 2 decades. But
unfortunately, we don't have the specific numbers for before 2000 multifamily absorption.
Well, I'm more curious in like quarter by quarter over the last.
Well, quarter by quarter. That's the really promising thing in the shorter term, I guess. So second highest absorption in over 25 years. That's what I was getting to. But the building to it has also been notable too. In 2022, we had a little bit under 150,000 units absorbed in the entire year. That's very low. And then it went up to a little bit under 350,000, so more than doubled in the next year. And then in the year after that, it's now at 546,000 in absorption. Again, the next highest beyond this. So second highest in over 25 years. The highest was 703,000 units of absorption in 2021, and there's a big fall off between number 2 and number 3. Either it's hard to describe the stellar absorption that we had in 2024 by saying it's in second place, but second place is pretty good in this case. You're really exceeding anything that you see in this chart, anything you see before the pandemic. And it also actually, I wanted to note this too when we were talking about supply and demand trends. So let's say usually 400,000 is as many new apartments that usually come in every year. At 70,000, which was the projected low point, we're still well off that 400,000. But I bet that what we really need is something more like 500,000 new apartments built because of the growing household growth, the growing
population,
absorption, and just natural trends that we'll see here in just a second. We are maybe in a world where we just need a little bit more apartments, and as you noted too, we are still in this deficit of housing that some of the numbers in this report will bear out as well.
Yeah. Well, and also want to look at unemployment rate, household estimates as some of the, again, just additional factors that are going to continue to drive absorption and demand in multifamily. Yeah,
that's exactly what I was thinking of right now. Is this difference between how much households have grown and how much unemployment has been stable. So when you're talking about households, they've grown considerably. And I was measuring actually the growth of actual households versus the growth of housing units. Yeah. And households have grown. Housing units have actually that rate of growth has gone down. So we are not building enough units. Period. But when you're talking about labor, the labor market surprisingly is fairly healthy. It's actually very healthy. It's at 4.1, remarkably stable, well under the 5% unemployment rate considered as to be full employment. And the home buying market is, on the other hand, has just increased a lot. The price for homes has been just the biggest barrier for people, and it's starting it's kind of reviving or really lighting a fire under the narrative of people choosing not to buy and maybe remaining renters. I think it's never been more persuasive now. The relative financial advantage of renting versus owning homes. Just to give a couple numbers here, the costs for home buyers have gone up from 6.98 times annual income to 7.28 times annual income. And when you add in the mortgage rates, those costs of home ownership go up even more. So not only are values of homes going up, from that same period, which is like around 2002 to now, interest rates have definitely gone up. So
I mean, just like we're showing a chart right here, Matt, showing the cost of ownership compared to renting. And again, renters would tell us, what are you talking about? Rent has gone up, and it has. But when you look at the kind of the parabolic nature of the cost of home ownership, there's really no comparison. And you're right. Before this all happened, we already had individuals that were just preferring renting from a variety of just lifestyle reasons. But now it's become less of a lifestyle choice and more of just you just can't afford to own a home. And then. But then looking at renting, again, talking about it's not just more affordable relative to owning a home. That doesn't mean the renting is still unaffordable. That's not the case. In fact, that home price or rent to income ratios, looking at, considering 30% of one's take home pay being spent on housing, and anything more than that is considered housing burdened. Those rent to income ratios have actually been coming down because rents have been flat or negative in most markets, while wages, because unemployment has been so low, have come up and have increased. I think it's worth noting, Matt, that based on the last section, if we have a recession, we could see a reversal in the low unemployment. We could see a spike in unemployment. Our base cases, though, depending on if a recession happens, it's most likely going to be a relatively mild recession. We could see some impedance to further rent growth and wage growth for a period of time. But again, our base case is it's going to be much more technical much milder, and the overwhelming, inelasticity of apartments and rental demand, and the fact that you need to live somewhere is going to continue to buoy multifamily growth and stability over the long term. Not that in the near term, as we're talking about, there couldn't be some disruptions and bumps in the road. But our whole premise and thesis here is you're going to be able to acquire assets at a value where you can be compensated for that risk of buying in a recession.
And assets that you can be confident that they will perform past this current environment of uncertainty.
Exactly. 100%.
Yeah. Just to also give some numbers about that rent to income, they did go down from 27.7 in 2022 to 25.7 now, which is a relatively big move for that metric. Usually, 2 or 3 percentage points is fairly notable. And again, amidst this environment where a lot of people are talking about how rents are high, that's a constant narrative, but the evidence shows, and especially amid this housing shortage, that income levels have surpassed. There's a little bit of a cushion for the apartment market.
Yeah, I agree. Let's talk about investment activity, investment sales, because it's been a slow market right now, man. I can tell you, as someone who's looking to try to, we're always in the market. We have challenges. Again, prices are too high, interest rates are too high at the same time, but transaction activity has picked up. People need to sell. There's funds that are coming at the end of their lifeline. They need to dispose of assets. Got owners that have been in a property they were trying to sell 2 years ago. They haven't been able to do it. They're getting impatient.
Yeah, I think pent-up demand is still really,
a lot of pent-up,
really impaired. Yeah,
and pent-up demand on either side, I'd say. Pent-up demand to sell assets as well as acquire assets.
Yeah.
The question is, in a potential recessionary environment, how many buyers will still be in the market to buy? But let's just talk about what we know from the last couple of years up until today. What does sales activity look like, and what could that tell us about the future?
So for the last part that we have full data for last quarter, it was $35 billion in sales activity. Now that is an improvement, and it has improved for 4 straight quarters since the low point of $17 billion in Q1 of last year. However, all of those numbers are well under the $115 billion sales peak that was in 2021. So that peak, it was 2022, but that sales peak quickly shot down, and in 2023 the sales picked up slightly, but then they came back down again. In 2024, every successive quarter has been improving sales numbers. So we are not anywhere close to what would probably be considered normal amount of multifamily sales activity, but I think it's promising, and to show 4 straight quarters of sales activity growth, sales volume growth is, I think it's really encouraging.
To me, this shows just as we were talking about, just the pent-up demand on either side.
And then also, just a couple points that you noted too. Apollo's recent $1.5 billion acquisition of Bridge Investments, and there was late last year Brookfield's recent $845 million acquisition of multifamily assets from Blackstone. There are big institutions that are transacting, and that they're kind of setting prices, and they're setting prices at cap rates that are a little bit lower than you might imagine. But I think that may be par for the course for these big acquisitions.
In many cases it is, but it is still making a market, and we're having some price discovery, which that was the largest challenge for so long, and it's still a challenge today of just there hasn't been enough price discovery because sellers are saying, well, no, my asset's worth this because that's where prices were selling the comps that I'm looking back at 2022. But that was peak sales activity, and that was peak ZIRP, and we can't use those as really effective comps for transactions today.
And I think that is an incredibly stark difference between now and 2023 and 2024. People are now realizing how far away 2022 was and how far away those high prices are. And you were talking about pent-up demand to buy and to sell, and I wonder, and I think we'll be getting to this in just a moment. There will be sellers that are forced to sell. There will be sellers that have to sell. They don't have a choice, and I wonder what impact that's going to have on the market.
Yeah, exactly. All right. So let's go to just summing this section up. I mean, low supply, 2025, end of 2025 onward. I mean, that's something that we can say for certain. I mean, if every developer started putting a shovel in the ground today, we'd see a pickup, but we have a pretty clear idea, at least over the next several years, we're going to be in a lower supply environment all along the same time. demand is incredibly healthy. Strong demand is anchored by household formation and rent versus buy dynamics. We just have well-anchored fundamentals. And then there's strong institutional investment demand, Matt, as you just laid out. And generally, one of the reasons for that is that multifamily, real estate in general, are recession-resilient real assets. They can have a proven track record to perform well and sometimes even outperform during a recession. I mean, every recession is different, right? The 2008 recession is going to be a lot different from the recession that happened in 2020 during the pandemic. During the 2020 pandemic, I mean, multifamily crushed it. I mean, the next couple of years, we had the best couple of years ever, multifamily. And then now we're in this situation where we are. That was an insane cycle. That's most likely not going to be the next case. But
it did demonstrate how a lot of investors were willing to invest at a point where job growth was really low, but they saw those low interest rates, and they had faith in the long-term prospects of the multifamily market, and then they really moved in that, and they kind of enjoyed the rent growth there going forward.
Agreed. All right, but why now? Why 2025? I mean, what? I mean, because you can say some of this is scary stuff. What's going to make 2025 the time? Because people have been looking for opportunities for years on the sidelines, and the whole survive till 2025. Now it's, whatever you're going to do and figure it out in 2026. But what makes 2025 so special? So we want to look at, again, we don't know what the next several months are going to look like, but we want to look at a couple different scenarios. Getting back to interest rates, this is basically the similar scenarios we were discussing when we were just talking about the recession probabilities. Now we're relating it back to the multifamily market specifically, and what would happen in those three different scenarios. Going into rates are being steady. Again, this will most likely take place during this year. Kind of the base case, if just we left them where they were, or Jerome Powell leaves them where they were, acquisition activity is going to remain cautious, but it's going to gradually recover. People are going to get used to it. There will be some rent growth, although we could see potential recession, which reduces the prospect of buying new assets. Cap rates most likely will elevate, which that's going to really be able to unlock that acquisition activity, because at some point people are going to say that that discount rate of the 10-year Treasury, and then also looking at the Fed funds rate, that relationship, that spread between interest rates and cap rates has to be rectified at some point, and we need to see some higher cap rates in multifamily. If we see some gradual rate cuts, we're gonna see some even significantly more increased volume, because people are going to be able to make deals happen. We're going to see some modest cap rate compression, and if we see some aggressive rate cuts, we'll see a lot of acquisitions take place. And specifically, what this will allow is for sellers to get the green light to come to market. Because what's preventing sellers from unlocking the volume of inventory that the market needs is this idea that why would I want to sell an environment where 10-year Treasuries are elevated above 4%? I don't think I'm going to get the price. And we have to have the volume of transactions and the price discovery really to see where we actually land. So another key inflection point that we've done, the Gray Capital, led by Matt, has published 3 research reports covering multifamily loan maturities, and it seemed like crying wolf, because the maturity dates kept getting pushed and pushed and pushed, based on guidance from the Federal Reserve. But 2025 seems likely to be the year where extend and pretend comes to an end. And again, we've got a whole research report that just covers this. But Matt, what's going to take place in the fourth quarter of 2025 that could unlock additional volume?
I think that, and this is just representing CMBS loan maturities, but I think that it's probably present throughout, is a lot of the loans that were perhaps extended or created in 2024 or even 2022. So let's just pretend here, hypothetically.
We've got the chart here that basically shows how they've been extended and pushed forward. And that's increased the volume of maturities.
So let's say they got a loan at the peak of this multifamily sales activity, which we've learned is 2022, and they get that loan, and it's a 2-year loan. 2 years later, in 2024, was a spike in loan. Or I'm sorry, they get the loan in 2021, which was this peak, and then in 2023 there was a spike in loan maturities that we covered, and it didn't really,
those maturities got pushed back. The banks said, "Hey, this isn't a good year.
Yeah.
Rates will be lower. The market will recover. We'll give you an extra year or two in many cases."
And so 2 years later, now we're into October, November of 2025. So they've had it extended once, and all signs are that an increasing portion, and maybe a lot of them, are not going to be able to extend in for a second time. This is maybe a kind of thing where if you have a loan so big it's the bank's problem, but I don't think that the banks are in the crisis mode that they were in 2020. In 2023, there was talk of the Silicon Valley Bank failure.
And the regional banks haven't.
There were some vulnerabilities there that haven't really been spoken about, at least in 2025. I think that there's probably in a healthier place right now. But this is all to say that what might happen as a result of all of this is buyers being forced to sell, whether it's to sell to get ahead of a multifamily loan maturity, or it is one that is forced by the bank, which I think is kind of a last resort.
Forced by the bank, forced by equity, saying, "Hey, look, this was supposed to be a 2-3 year hold, and now we're in year 5, 6, 7, or longer. Let's sell this thing." There are investors out there that are saying, "Just give me my money back." And in the case of lenders, typically when we're looking at deals, we see that the values oftentimes end up equaling the value of the loan. Mm-hmm. So the lender isn't necessarily at risk of default, but they want their money back.
So, and this is a more general question. CRE people that are looking for acquisitions, are they looking? Do they use loan maturities as kind of a timeline for when opportunities might emerge? Is that when sellers typically sell, is when their loan's maturing, or is there a different time?
So you got to do something, right?
Yeah.
You either got to refinance it or you got to sell it. In many of these cases, the refinance was going to require them to bring millions of additional capital to the closing table just to continue ownership.
Yeah.
They're going to their LPs, and we're hearing this from LPs every single day when we're talking to them, that like the deal that I invested in the last 2 years, I'm getting a capital call. What should I do about it?
Did you tell them that we've never had a capital call?
We have never had a capital call, man. It's true.
I guess it's really it's not that reassuring to tell that to investors, but it's reassuring.
But so much of the market is, and it's sad again, and it's a reality. It's just how cycles and just business is. But not all of those sponsors are going to be successfully raise that capital. Some are looking to preferred equity, to private credit to fill that gap.
Yeah.
And if all of that doesn't work, at some point they say we're just going to have to sell it. And even if it is a near loss of capital, a partial loss of capital, or a complete loss of capital, that's already happened in this market. And the way that, again, this maturity, wave, it's less of a wall, it's more of a wave. It's going to crest, and there has to be something that happens, and it's not going to be widespread though. That's the other thing that we know. Mm-hmm. It's not as though it's every deal in every market. It's concentrated in the Sun Belt, but a little bit everywhere, but certainly concentrated in the Sun Belt, and it's pocketed in those Sun Belt markets as well. And it's the older, typically value add strategies, kind of older vintage properties, value add strategies that a lot of middle market syndicators bought over the last couple of years. Some of them looked like solid deals on paper that were in air quotes conservatively underwritten. Mm-hmm. Just interest rates moved too quickly, and in the case of the Sun Belt, no one was expecting so much negative rent growth. I mean, Austin, Texas has rents declining by an additional 9% year over year, and that's compounding over several years of negative growth.
So kind of to relate this situation for potentially troubled or distressed or stressed apartment owners facing maturities to the larger macroeconomic things that we discussed earlier, in some of the dicier scenarios, maybe there is a recession that causes lower interest rates. My thought is that if rates come down, that recession could also cause rent growth to come down, and because properties are are valued based on like the income they generate. So if the rents come down, then the value of their property may come down in a way that is more than the value would have come up because of lower interest rates and cap rate compression.
But you're right. Every market, it's going to be different. There will be some properties and some submarkets and submarkets, even in a recession, that still have positive rent growth. That still end up doing well. A lower interest rate is going to make that very attractive. There will be other markets in properties where they're going to experience negative rent growth, regardless of whether we have a recession or not.
And again, why 2025? And the point again to these loan maturities, it's not just CMBS. They are more, and the $5.4 billion in CMBS maturities expected in October 2025. That's actually it's not going to get that high until August of 2028. So that will be true, and it is. You'll see this reason for a lot of people to sell into the markets, not just pent-up demand. It's maybe something where you have to do something, and I think that's going to have an effect. It may not be a flood, it may not be a crisis, but it may just generate a lot more deals, a lot more opportunities for people to make acquisitions in 2025.
Yeah, a good point. So to sum things up, deal volume is set to increase. Whether it's through loan maturities, whether it's through forced selling, whether it's through impatience of banks or equity. The deal volume should increase, especially over time. There's the possibility of further price declines. It's not an absolute certainty, but there's certainly that probability is out there. The market fear is going to reduce competition. And that's one of the big points we're trying to make today is that there will be individuals that move back to the sidelines because it's hard for them to make a decision because they don't have a longer term view. If we are in a recession, if we go into a recession, it's not going to look pretty. People aren't going to want to make big calls. It's the few that do end up being the winners on the other side. Not that there's not risk and it's just simple as just running into the burning building, but the opportunities should present themselves or have the possibility of presenting themselves. We're going to see lower supply over the investment horizon. And again, that's what we have to keep thinking about. We're not talking about this year or next year. We're talking about 5 and 10 years. We're going to see lower supply over that investment horizon. And lastly, the demand fundamentals are anchored, whether that is rent-to-income ratios, whether that is just the lack of supply, household formation rates, the preference of renting versus buying. Demand fundamentals are anchored.
And both of those trends, the low supply and the high demand, are trends that have been operating for years at least, and been building momentum. And now we're kind of seeing the fruition of a lot of things that have been developing for a long time, much longer than the current uncertainty.
And I guess lastly, just to conclude, and this is very macro, it's big picture, but we have to remind ourselves of some of the reasons why we like multifamily as an asset class in real estate. And I mentioned it earlier, but it's a real tangible asset for the same reasons why gold has been increasing in value over the last several years. In many ways, real estate, multifamily real estate, is a hedge against the declining dollar, a hedge against hyperinflation. For the same reasons why people like gold, multifamily is also attractive. The difference between multifamily and gold, though, is you can actually live in multifamily. It has a much more tangible use to society, and it creates cash flow. It creates income, and it has inelastic demand. So it's an attractive asset class in recessionary times, in uncertain times, because we can have uncertainty, but at the end of the day, we still need a place to call home. You still need to go live somewhere. Where those prices are, where the asset values, there's a lot in between point A and point B. But again, taking a long-term view, we can rest assured that allocating to multifamily at price that makes sense, when the asset cash flows with strong NOI and good markets with positive demographics, it's good long-term fundamentals, which is critical to just continue to focus on.
I agree. Is there any place where people can learn more or maybe read a report
Well,
like.
you know it, Matt. Absolutely. In fact, why don't you hop over? It's in the chat. It'll be in the description below. But if you want to download our latest report called the Multifamily Window, you can go to graycapitalllc.com/window. It's got much of the charts and graphs that was in today's webinar. This webinar is going to stay on YouTube, so you can go back and rewatch it. We've had some extra stuff on the webinar just to give the full picture. But you want to make sure you're subscribed, not only to the Gray Capital YouTube channel, but also to our newsletter, which you can find on our website. There's going to be a link below. Just go to graycapitalllc.com. You'll be able to find it. We send a weekly newsletter Thursday morning, 8:30 in the morning, Eastern Standard Time. It includes all of the latest research reports covering multifamily industry and commercial real estate. It's been going on without a hitch since June of 2020, Matt?
Yeah,
July, August, something like that.
We're almost 5 full years.
5 years, never missing a beat. There's also a small digest on Sunday. But when you sign up for the Gray Report newsletter, you're going to be directly sent all of these research reports when they come out. So it's a highly valuable, and it's free. People tell us all the time, you guys need to start charging for this stuff. But we love doing it. We're obsessed with multifamily, real estate, tracking the economy. It's something that we love to do. It's critical to our business, and it's a major component to that. I think we're probably one of the most, if not the most, data-driven, multifamily investment firms. And certainly we're putting out that research and try to put actually we try to walk the walk as well. Not just talking about it. We're also practitioners doing tens of hundreds of millions of dollars worth of multifamily transactions over the last several years. So, all right, let's see if we've got any questions. There were just a couple. Christian Rooney, how's it going, Christian? A couple questions. I think it's coming down to one, and I think we may have answered a little bit, but he says, however, guys, if we go into a recession and we have some turbulence and the rates crank way down, that could change real fast. 100% agree. We touched that on a little bit, and I agree. The Fed takes quick, decisive actions. It's in a different ballgame. As I said, either prices need to come down or interest rates need to come down. Prices can stay where they are if interest rates come down. We can make a lot of sense of some of these deals, potentially what's going on in the economy. If interest rates come down, that will largely save the market. You have to ask yourself questions of, further inflation. That depends on where inflation is. If it's continuing to recede, or are we going to see a kick up of inflation?
And that also kind of makes me think about how the underlying economy and the underlying economic trends before the current uncertainty were fairly robust, fairly strong. And what is happening now is a lot of is dependent on the decisions of the Fed, or maybe the decisions of the Trump administration with tariffs and the government reorganization. But but inherent in itself, it's not like we're building towards another great financial crisis. There is all of the trends, even the jobs numbers right now are fairly healthy, and so hopefully that will lend itself to a kind of transient thing. But there's still uncertainty, and it's hard to not. It's important not to forget that.
I've been doing a lot of studying of the 2001 recession, which was there were several causes of that. It was the .com bubble. What was a major contributor to that. The Federal Reserve had been increasing interest rates, which was a contributor. Then we also had 9/11, which was really kind of the last nail in the coffin that kind of pushed the economy into recession, because it was we were worried about terrorism and we were just uncertain about the world. But again, it was the Federal Reserve had been pushing things over as they were increasing interest rates, trying to tamp down kind of the speculation of the .com bubble. But it just goes to show in that case, again, 9/11 being that inflection point, and we're not going through 9/11, but the tariffs and this trade talk has similar effect of just how are we operating through the world, and what does the future look like? And it's just a little uncertain right now. And so, but since we do have a lot of positive underlying fundamentals in the U.S. economy, I mean, I think AI is going to be a major driver of productivity in the United States. I think the United States is going to have a really prosperous, next 10 or 15 years if we can, get our stuff together. But we got to get through whatever this reshuffle is, and have some clarity and start making some decisions again. a lot of this volatility in the short term. I don't know what the outcome will be, but it's not easy to operate in.
Yeah.
So just you have to ask yourself: are you going to be a participant, or are you going to be observer?
Yeah.
In the opportunities that come, and you can be an observer and you can avoid a lot of pain, but then you look back in 5 years and you see in retrospect all the opportunities that you missed.
Yeah.
And say, my gosh, if I could only go back. And I remember telling myself this in 2014, if I could only go back to 2009.
Yeah.
If I could only go back to
Yeah.
2009 and buy all the real estate.
Yeah.
And I looked around in 2014 and the fundamentals looked pretty good. And I said, I should just go and buy it go buy all the real estate, all the multifamily.
Yeah.
You can't operate like that. You have to underwrite and do deals that make sense. But in retrospect, I probably could have bought just any deal in 2014 and have done incredibly well. So not saying you ever do anything blindly, even close to like that.
And that's what you don't want to panic either, right? No. You want to make informed decisions, and you want to be able to see that. And I think what we're doing right here is kind of identifying the trends and hopefully giving people enough of a runway to make an informed decision, and one that's not like a last minute panic driven decision.
And again, the conclusion, the futility of forecasts.
Yeah.
We're here on this webinar saying, this is what the next year and 2 years is going to look like. Nobody knows, and we don't know. And we're the first to admit that. But certainly putting all the evidence and looking at the probabilities and seeing what could happen and preparing yourself for if this, then what, and how are you going to react. Because otherwise you will be driven by the kind of the transient nature of the next story. And you're going to be reactive rather than proactive.
Yep.
And so, at Gray Capital, we're being proactive. We're preparing for this. We're also, ready to operate his business as usual and just kind of keep taking it day by day. But seeing the possibility of this opportunity, we want to make sure that we're fully prepared to take advantage of it if it does fully present itself. And one way you can participate along with us, follow us on the journey, whether that's just listening to what we do on the Gray Report, talking about deals, or partnering with us. Again, make sure you're subscribed to the Gray Capital YouTube channel. And we'd love to have a conversation with you. Sign up for a meeting with the investor team if you're an accredited investor. And we'll talk to you about some multifamily deals. Cool. Matt, this is a great report. Again, pop over to graycapitalllc.com/window to learn more. Everyone have a good day. Thank you.